All right, we're going to get rolling here. Happy Thursday, everyone. Thank you for joining us today. Just a little housekeeping before I introduce our speaker. This is anonymous attendance. In order to maintain that, you can utilize the Q&A panel and select the option to ask your question anonymously. You can also raise your hand and speak to Aaron, but do know that the name you registered under will be displayed on screen, so be cautious of that. With that, I'm very pleased to introduce Aaron VanTrojen, the CEO and founder of Geneva Financial, recently named Legend of Lending by National Mortgage Professional Magazine and featured cover story on Mortgage Banker Magazine, as well as named a top 100 CEO in America by Business Insider. Aaron is here to talk to us today about a few things, including how he has managed to keep his company performing, outperforming most of the industry during 2 years of market volatility, as well as how you can double or triple your compensation with his platform that is quite unique to the industry. So with that, Aaron, the floor is yours.
Well, happy Thursday, everybody. I'll start off with just a quick backstory on the inception of Geneva Financial, and then we're going to go into some extreme differences between this company and the competition, which has held true for now 17 years. I do, like James just stated, is know that if you ask questions verbally, your name might show up. I don't care, but you might if you don't want other people to identify you. I think that's probably a little oversensitive, but I encourage it. So I do encourage questions. I do encourage interaction. I want you to learn from this. And so if I say something that you either don't understand, you want additional color on, or if you just think that I'm nuts, I'm open to be challenged on it, and I'd like to explain things further. So I do encourage involvement. So feel free to raise your hand, unmute yourself, or certainly chat the questions that you might have. So I'll get started first. Just quick backstory to not put you guys to sleep. But I started in the business as an originator in 2001. Became very successful as an originator and later as a branch manager. My former employer sold to a large mortgage bank in 2006, at which point in time I determined as a high-producing originator branch manager that I wasn't ever going to be able to survive working for a large bureaucratic mortgage bank. So in 2007, October 2007, for those of you guys who were in the business at the height of the mortgage meltdown, we started a mortgage bank. It was a licensed mortgage bank. Although in 2007 being considerably undercapitalized during the biggest meltdown in our industry has seen, nobody was going to give me warehouse lines. So we continued our path, at least at inception, as a broker, which I'd been for most of my career. So that wasn't challenging me for me to do anyway. We had no intention to stay a broker. Our goal was always to be a banker, and that was largely due to economics, and not economics for the company. It was due to the economics to the originator and branch manager, which I'll get to in just a few minutes. So over the course of time, since 2007 to today, we've been through a lot of ups and downs as a company through the industry changes. And we've continued our growth, mostly organic, over the course of this time. We're still a relatively small mortgage bank. We operate in 49 states. We have roughly 700 employees scattered amongst those 49 states. So we don't have any large density anywhere. And unlike most mortgage banks, I'm not motivated by X amount of volume. I am motivated by profits, and I'm actually more motivated by helping others learn how to become more profitable, which I spend a great deal of my time educating people and teaching people on how to become more profitable as an originator, as a branch manager, so on and so forth. So that's a little backstory where we are as a company today. We still are growing as a company. Most of the industry's contracting. We're not. We have nice, slow, steady, controlled growth, which we will continue to have. I think the big swings in industry volumes that we've seen over the decades have less an effect on Geneva Financial, largely because of how we're structured, and I'll go over that in just a few minutes. For most of our history, James, if people are asking questions, I don't know where I don't see them, so I don't know if I'm supposed to be looking
I,
for them.
I'm moderating for you.
Okay,
I'll
good.
pause you.
Just like, okay.
I
Um,
got you.
so, for a great deal of time of our history, we led with the compensation factor, that we pay radically more than any of our competitors have, which has held true for 17 years. Nobody's ever come close to paying as much as we've paid. We don't lead with that anymore. That still holds true in every single case, but we, over the time after we've evolved and become a more robust company, we lead more now with, our marketing, because our marketing is more innovative, intuitive, robust than any of our competition. And our marketing, especially in this day and age where people are struggling to grow their origination business, or branch managers that are struggling to recruit and grow their footprint, our marketing really helps you do that. And it's considerably different than what the industry is doing. So we lead with marketing. I would never lead with we close loans on time, because every company should be doing that. So yes, we do that. Let's just take that off the table. If your company's leading with that, there's another problem. So that's not an issue. Technology. Sure, we have all the latest and the greatest and innovative and robust technology. It's integrated, it's seamless, it talks to one another, it works. But the problem with the industry, with our industry, when it comes from technology, is technology. The big industry, the big corporations in our industry, is really using technology to automate loan officers out of a job. If you don't believe that to be true, it is, and certainly watch what happens over the next, I would say, 12 to 24 months. A great deal of money is being poured into technology to eliminate the biggest expense of the origination, which is the originator. We're completely different, always have been from a technological standpoint, because we want to give you the latest and greatest technology to help you become more efficient, but to work behind the scenes. And I think that there's a tremendous amount of value to being a human forward, have the human interaction with your customer. And I think that may have a lot to do with why we have not been as affected by margin compression as our competition, because we're able to manage and grow and build on the relationships, the human interaction that we have with our clients. While we have the technology that can pull you out of that equation, we really reinforce that you stay engaged with your customers, which again gives you the value. Like I've always said, I've never seen a mobile application build rapport. Never seen a mobile application be able to build trust. Never seen a mobile application overcome objections. So again, if you're heavy technology forward, but you're getting price shopped and you're doing heavy concessions and you're getting beat on all these deals, that's the reason. You don't have value, not bringing value to the equation. Bringing technology to the equation is a value to your consumer. Using technology to make you more efficient, yes. To help you close transactions in a timely fashion, yes. But certainly not when it comes to building trust and rapport with your customer, which is sales 101. Very heavy into the sales component of originations, because an originator is a salesperson by definition. We'll get to that in just a little bit as well. I think one of the greatest limitations of our mortgage industry, since I've been in it since 2001, is they've largely, the industry, the companies have largely not taught people how to actually be professional salespeople. I think that's more than apparent in the last 2-3 years with margin compression, because the overwhelming majority of our industry leads with price. Even companies out there trying to recruit you, we have the lowest price, 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 which means they have the lowest compensation, and most importantly, the very lowest value. Because if you lead with price, you have the lowest value. That's a big ask for people to grasp that concept, especially in the last couple of years. But Geneva as a company have been proving year over year that it's not about price. Everything is about value. And you'll hear me say this over and over and over and over and over again. You as an originator get paid exactly for what you're worth. So if you've seen your compensation drop in the last 2 to 3 years, it's because your value's gone down. It has. It's not because your market's more competitive. It's because your value went down. And if your company took compensation away from you because of margin compression and you allowed that to happen, again, that's a reflection of your value. I would never let a company take money from me. That would be insane. So we have a different philosophy, a different culture here. The culture here is build your value, become extremely valuable to, if you're a branch manager, to your loan officers. If you're an originator, becomes extremely valuable to your customers, and then you won't have to lower your compensation even when you're in a state of margin compression. There's fewer transactions that you're fighting for. Again, if things get very, very challenging, why should your value or your value go down? It should be completely opposite. When things get very, very hard, your value should go up. You become more valuable to the consumer, i.e., you should be able to earn more, regardless of market. Maybe we'll touch on that. That's a whole nother rabbit hole I can go down. So let me talk about the big differences and why we can compensate more than anybody in the industry and have for 17 years. And again, I've not been proven wrong, not once, not ever. But it comes down to being able to get to apples, which is the biggest challenge when you're having a conversation with somebody about price versus compensation. Because everybody thinks that if Geneva Financial pays so much more than the competition, well, they're just simply charging more. That's not true. That's not what we're talking about here. Now, we might have branches or loan officers that do charge more because they want to earn more money, and they can go to market at a much higher value than maybe their competition, but that's not what we're referring to. What I'm referring to is based on any given price point that my competition's charging to the consumer, the same price point with us will generate you larger net income, okay? So for the sake of this example, if you're going to market right now at a 6.5% rate at a 1% discount, or charging 1 point, 6.5 at 1 point, our 6.5 at 1 point would net you greater income in every situation. And it's critical that you get down to being able to compare apples to apples, because if you go up against one of a Geneva Financial loan officer in a particular state, and you're like, well, dude, your loan officer's at 7%, I'm at 6.5%. Well, what are you earning at 6.5%? You might be earning 100 basis points where they're earning 400. So you're not comparing apples to apples. You're not comparing apples to apples. And if that loan officer in that particular market has the ability, it's nothing to do with market, but has the ability to earn 400 net, 400 basis points. Most of them don't net 400 basis points, but I'm using this as an example. It's because they have the ability, they have the value. And whether that's a component of the robust marketing that they have to help build their clients over periods of time, creating relationships, value add, and their ability as a professional to be able to educate the consumer on the market, on proper financial decisions that they should be making as a consumer, a variety of those different variables. I would say that overall, our loan officers bring more value to a transaction than most of the competition, thus they can earn more money, which means they can charge potentially more. But it doesn't always work out that that they have to charge any more. So over the last few years, there's been a huge rift between retail versus broker. Okay. So let's have some fun with this. Brokers lost market share in 2020 and 2021. Why? Because deals were falling out of the sky and it was easy to make a ton of money. Okay. People were less price sensitive, i.e., the loan officers were less price sensitive because they just had more loans, right? They had more loans. They weren't fighting tooth and nail over every loan. And if they were losing a few deals here and there to competitors, it didn't matter because they had a robust pipeline and they were always making money. So the loan officer was less price sensitive. It's never the consumer. It's always the loan officer. The most price sensitive person in any given transaction is the loan officer. Okay. Is the loan. It's not your consumer. It's the loan officer. And how price sensitive the loan officer is in any given situation usually has to do with their professionalism and their salesmanship. If they lack professionalism, meaning they don't have a great deal of knowledge about what's going on in the market and they have the inability to educate their consumers and referral partners, or they have a hard time overcoming objections, so on and so forth, they're lower in those particular skill sets, their value is typically going to go down. Okay. So brokers made this huge run in 2022, largely because they sold the brokers are better mantra, which is complete BS because one, if brokers were better to the consumers, brokers typically, even if people on this call are brokers, most brokers violate every single law that was ever designed to protect the consumer. They may not even know they're violating the law. Their company might be allowing them to violate the law, but they are in fact violating the law. I'm not saying they're doing it intentionally. They just typically do it. So that wouldn't be better for the consumer. The other thing is that most brokers are allowed to change, not allowed legally, but their company allows them to change their compensation willy-nilly per transaction. In lies the cheaper part, right? One, I would never go to market saying I'm cheaper. I'm not cheaper. I'm never, as an originator, as a professional, going to be cheaper. That's not a good thing. That's not a good quality to be cheaper, okay? Not what I'm selling, okay? So anyway, back to what I was saying. So the loan officers in broker models have this misconception that they're able to change their compensation willy-nilly per transaction, which is not only a loan officer compensation violation, but also a fair lending violation, which we can get into later. So they're better because loan officers that don't have any value can go to market and win a deal for 50 basis points. But that does make you cheaper. It does. It makes you cheaper. And most brokers were cheaper. Again, not a good thing. But from a compensation standpoint, the only reason why they were cheaper is because they were earning far less. Okay. Also not a good thing. And there was a brief moment in time where companies like United Wholesale Mortgage were funding loans at a loss intentionally to take up market share. Well, that's not a long-term strategy. It's not sustainable. It's not scalable, which is why, United Wholesale Mortgage went from the price leader last year to now they're like 20th. They're terrible in pricing. And again, in 2020 and 2021, Geneva Financial smoked them and most brokers from a price compensation perspective. Okay. So remember, if I'm ever talking about beating a competitor, what I mean is that I'm always going to pay you greater net income for the same price points. Always. Always. All right. So you got the brokers that come out and they're beating up on the retail shops because the retail shops typically are bloated. That's why I started my own company, because I wouldn't work for retail, even though a lot of people would technically say Geneva Financial is a retail model. Okay, I'll concede. We are a retail model. but we are radically different than our retail competitors. Here's how. The reason why I started this company is, one, I wanted to make money that I thought I was worth as an originator, and was able to make as an originator, as a branch manager, and the other retail shops weren't going to pay me that. They weren't. So I started my own company. And I also refused to work for my competition. So even today, I wouldn't work for my competition. I'm not saying that my competitor is bad. I just ain't going to work there. Right? I think I'm too valuable. I bring too much to the table. Most of them aren't going to pay me what I believe that I'm worth, and have been proven that I'm worth as an originator for the last 23 years. But the other difference is most retail mortgage banks are bloated. Layers and layers and layers and layers of management. And what I mean by that is, I know that as a mortgage bank gets bigger and bigger and bigger, there's going to be more people. There's just more things to do. There's more responsibilities. But they get lazy. They get lazy. And what I mean by that is, when you talk to most loan officers and you ask them, what does your branch manager do for you? The answer is nothing in most cases. Not all. We definitely try to be the exception to the rule. I want to make sure that my branch managers earn exactly what they're giving to their loan officers. It should be in balance. But it's not with most companies. And if you go to most branch managers from retail operations and say, hey, what is your district manager and your regional manager and your state manager and your SVP and your MVP and whatever other acronyms they have for their titles do for you, the answer is typically nothing. It's just a lot of hands in the cookie jar. And so you're dividing this pie into so many slices. And at the end of the day, the loan officer gets crushed. So we can beat all retail operations because, one, I don't have bloated management. We run very, very efficiently. My branch managers typically, in most situations, report to me. They don't have 6 managers between them and the CEO, like most of our competition does. There is times and places for division managers and regional managers, but it's very, very rare, in my opinion, for this industry. And most of them don't do anything. There are exceptions, but most of them don't. I've met very few in my 2 decades in this industry that actually earn their keep, so to speak. So we don't have layers and layers and layers of management, which means there's a lot more income per transaction that goes directly to the originators and branch managers. Second, and probably even more importantly, is corporate greed. I don't have any problem with greed. I want loan officers and branch managers to make as much money as they ever could make. That's up to you. That's not greedy. If you want to make 500 basis points per transaction, have at it. Hopefully you're delivering the value that matches what you're earning from the consumer, but you should make as much money as you think you're worth. I like it. I encourage you to earn as much as you possibly can. Not take advantage of people, not gouge people, but to earn as much as you're worth. And not all people are the same. Not all people are going to bring the same value to the table. So that's that number is going to ebb and flow substantially from person to person based on their professionalism. 2020 and 2021, the average mortgage bank netted after expenses, i.e. net, after payroll and compensation, well north of 200 basis points. That's the company. The company netted that. Since inception, Geneva Financial's tried to net 50 basis points. I'm very transparent. I'm very open about that. So when times get fat and happy, Geneva Financial does not raise their margins. So we didn't raise our margins in 2020 and 2021 when deals were falling out of the sky. We didn't raise our margins. What we did is encourage all the branches and loan officers to earn more. I didn't make them earn more, but I encouraged them to earn more because it could. The business got easier. There was tons of business to be had. The price sensitivity came down substantially. So I educated them, let them know, hey, listen, You can probably increase your margins if you want to. You can earn more. Here's a time that you can earn more. Not Geneva Financial. We made a commitment to try to make 50 basis points, net 50 basis points inception. We've never changed that model. The flip side, 2022, things get really, really hard. I don't lower my margins. There's no reason I should. Business is getting harder. I'm taking on more risk. I'm working harder. Why my value doesn't go down? In fact, our value goes up because we typically have to spend more money and work harder to help our originators and our branch managers be successful in challenging times. So there's no sense that my margins should go down. And if you've been making all of this money with your high compensation as a loan officer, your high compensation as a branch manager, and you can no longer bring that value to your consumer, then lower them. That's your decision. So that's the benefit. That's one of the biggest benefits of Geneva Financial is we don't move our margins up and down. Most of my competition, and we can tell when we're pricing loans on a day-to-day basis with our competitors, is they can move their margins, their corporate margins, multiple times a day. A day. And I'm not faulting them for doing this. I'm not throwing stones at my competition for doing this. Maybe they're smarter than I, but that's just not our model. When we started Geneva Financial, I knew that at 50 basis points doing what we were doing, I would be able to accomplish everything I needed to do. That's where the greed factor came in. When I came to the realization that I could earn a lot more, there was no need for it. My goal was to encourage other people and teach other people and train other people that they can make a lot more money than they think they can. So we didn't make nearly as much as our competition did, the other retail banks in 2020 and 2021, because they radically increased their corporate margins. We didn't. This is, by the way, public. So you don't even have to take my word for it. All the data on profitability for the mortgage banking industry is already published. So you can look this up. When things got hard, this is where things really changed in our industry. The average mortgage bank in the fourth quarter of 2023 lost -3 or -73 basis points per transaction. That's net loss. The mortgage banking industry has been hemorrhaging cash for the last 2.5 years, hemorrhaging cash. In fact, almost none of the mortgage bankers out there have been profitable on originations. And the only reason that they're still in business, because as you might know, to maintain their covenants and everything with warehouse lines and agencies and so on and so forth, they can't have 2 negative quarters in a row. That causes huge problems for our industry, which is why you've seen so many of the mortgage banks crumble. These acquisitions and mergers, they're fire sales, they're asset sales, they're failures. Anytime you see a mortgage bank sell in the last 2 years, it's because they were collapsing. Wasn't a good thing. They were losing money. But the only reason the mortgage bankers haven't all gone away, because there's very, very few that have made money in the originations, is because they're selling servicing, which I always thought was absurd, that you could sell off servicing an asset and calculate it as income to offset the losses on your originations. But they have, and they still are today. Which is why, again, United Wholesale Mortgage finally, who again, not to pick on United Wholesale Mortgage, got great respect for that company's history and what Matt's been able to do with that company over the course of time. You know, a company that swore they would never sell servicing. Oh yeah, they're like one of the biggest sellers of servicing because they've been losing so much money on the origination. They had to sell servicing. And again, that's why their pricing's gone up through the roof. I mean, we're right now boarding an entire mortgage brokerage, a company, not a individual loan officer, but an actual company right now, because we're smashing them on a price comp perspective, and they sell all their business to, or they broker all their business to United Wholesale Mortgage. We're smashing them. A retail shop. is smashing United Wholesale Mortgage right now from a price comp perspective. But we have for most of our history anyway. This is nothing new. And the reason that why Geneva, again, is capable of doing that, not only against our retail competition, but also our wholesale competition, is, again, the company's designed to try to net 50 basis points, which is far lower than the industry. 2, we're really, really efficient. And 3, we don't have bloated management, which keeps us very, very, very competitive. But again, not chasing price. Don't care about price. It's the compensation from that price. How much money is being earned from a price perspective?
Hey, Aaron.
Yeah.
We had a question come in on private chat. What do your branches make on government and conventional?
Okay, so I'll answer that question the best that I possibly can. There's no set answer because branches that are in different markets can have different margins. And I want to make sure that everybody understands. So I'll try to make this as clean as possible. The overwhelming majority of branches are netting. This is after expenses, okay? Netting probably in the 275 to 300 range. And on governments, probably 3.25 to 375 net. So if the person asking that is a branch manager or anybody else on this call is a branch manager and understands margins, that's net margins, not gross margins. And again, a big difference between us and all other retail companies that run P&L models. We do run a P&L model, but ours, again, is radically different than every single one of my competition or competitors that at least that I've come across in 20 years. So I assume that this is true across the board, is we run more of a near net P&L model. Our branch managers do not pay credit reports. They do not pay for AUS. They do not pay for LOS. They don't pay for mobile apps. They don't pay for VOEs. They don't pay for VODs. They don't pay any per file fees. They have no warehouse cost fees. They do not pay the employer taxes on commissioned employees. So their margins are near net because they don't have to gross up their margins substantially, offset all the corporate expenses. And today, an average corporate expense from my competition can range anywhere from about 125 to almost 200 basis points in corporate expenses. At Geneva, 0, none. Now, if they have self-inflicted expenses, like their lease, that would hit their P&L, or if they have chauffeurs and secretaries and that sort of thing, that's going to be on their P&L, but we don't hit them and nickel and dime them for every expense. So when I talk about Geneva margins, they're net. When I talk about our compensation is overwhelmingly net. So the average loan officer, this has gone down substantially in the last 2 years, only because we've brought on branches that are more price sensitive than our existing branches. So going into 2022, our average net loan officer compensation was probably about 175. Even if they used an LOA or a processor, we didn't deduct those fees from that in most cases. So that's probably closer to 150 range right now as a company. Not because we lowered it, it's because of the branches that we brought on tend to be more price sensitive and they're accustomed to paying their loan officers a lot less. But our branches, loan officers that are in our branches make a lot more than all of them. Again, the brokers that are out there saying, we'll pay you 275, it's horseshit. One, it's gross. It's gross. Who cares what you make gross? What did you net? Okay, and to take it a step further, if any of you guys are on brokers out there, 275 in most cases. So you take my biggest broker competitors, and the average 275 is going to dwindle down to about 150 net. Not bad, not bad when you compare it against an average retail bank. Not bad. Okay, fine. I understand the argument there. 275 gross down to 150 net, not bad. But what do you get for it? Nothing. And if you think that the broker technology and marketing is on par with what we have to offer, you have no idea. You have zero idea. Complete misconception. Also, it's an unscalable platform. Wait, before I get to unscalable platform, let's get back to that. So that's assuming that the loan officers are 275 gross, assuming that the loan officer goes lender paid. Okay, but if they go borrower paid, those numbers change substantially. And so when I talk to brokers, which I don't do a lot of, but when I do talk to brokers and I talk to them, like, how much do you make? Well, I make 275 lender paid gross. And when I go borrower paid, it's usually like 80 gross. And so then you have to keep asking questions like, okay, so you did 4 deals last month. How many were borrower paid versus lender paid? In almost every situation, at least from my experience over the last 2 to 3 years, almost all of their transactions are borrower paid. So the real loan officer compensation might be 100 or less gross. I mean, if I was making under 100 basis points gross as an originator, I just drive Uber. I just do that full time, which is maybe why most brokers do drive Uber. Again, not to throw stones at brokers. I love them. I was a broker most of my career. I was even the president of the association. It's saddening to see what's happened to that community, all based on price.
Hey, is there a chauffeur that I'm missing out on? We got a follow-up question on that P&L stuff. Their question is, what's the visibility into their P&L?
Every day you have direct access to your P&L.
Yeah, with Loan Vision, if you guys aren't familiar with that.
Yeah. So, and again, our P&L, you know, a competitor's P&L could be several pages. Most of our branches, it's 1 or 2 pages, because again, there's not 40 line items of expenses. All the things that you're getting buried with, your expenses that you're getting buried with, aren't on my P&L. Corporate covers them, and we don't cover it because we're just nice. Of course, that's built into the pricing perspective, right? If the real cost to Geneva for credit and technology and LOS and so on and so forth and credit reports, again, all those things have experienced great inflation over the course of years. When we went to this model, we weren't always this model. When we went to the near net model, we did it back in 2014. I did it for the ease of operations, right? It made everything so much easier from a branch manager perspective and also a corporate perspective. And the average corporate cost to a branch was about 3/8. Okay, that's about what, I shouldn't say 3/8, call it 37 basis points, 37.5 basis points. Now, due to inflation, I mean, credit reports are up, 600% since then. LOS and Compass is up substantially. Everything's gone up substantially in price in the last 10 years. So the real costs are probably pushing up against 80 to 90 base real costs. And yes, of course, it's built into the pricing, but it doesn't matter, because what matters is, again, your 6.5 or your 7% interest rate pays you what? And like I said, at the end of the day, I'll match your price point to the consumer. My compensation is going to be higher. It's going to be higher. It's going to be higher every time. Now, again, brief window of time last year where United Wholesale Mortgage was losing their ass intentionally on every single transaction. I might not be able to bridge that gap, because I'm not going to do loans at a loss, nor would I ever encourage you to. Right? I'm not going to. And again, out of complete transparency to the company or to everybody on this call, we don't intentionally service. So we have not sold servicing to stay profitable. We haven't needed to. We've been profitable on originations. I think we've been negative profitability 2, maybe 3 months in 17 years, not quarters, months in 17 years. And the reason why is we go to market with value. In the last 2 years, I think we've had 23 branches that have raised margins. We've had 0 that have lowered. Greatest margin compression ever experienced by this industry, yet our branches are raising margins. Why? Because they can. And you know what? It doesn't matter where they're located. Makes no difference where they're located. It's irrelevant. That would be a hard pill for a lot of you guys to swallow. Because again, most of the conversations that I have when I'm recruiting other branches, so on and so forth, or companies, is they almost always lead, well, Aaron, my market's unique because it's very price sensitive and sophisticated borrowers, blah, 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 blah. Not true. Not true. If it was true, every single loan officer from every state and city and across this country wouldn't lead with the same thing. It's not true. It's in your mind. Some other differences between us and probably all the competition is if our loan officers get into a competitive situation, have to compete, which they can. They use concessions to compete, and they can beat anybody out there if they wanted to. Your compensation doesn't go down. That's illegal. If your compensation goes down when you get into a competitive situation, your company is in violation of federal law, and you might be as well. That's illegal. They're stealing from you. I would never steal from you. So if you get in a competitive situation, have to give a concession to win the deal, your compensation does not change on that transaction. Does not change. If you do down payment assistance loans, which I don't encourage, we do them. Don't like them, nor should you as an originator, but let's just say you build your business and you do down payment assistance loans for people who don't have any money and poor credit, so on and so forth. Your comp doesn't change. That would also be illegal. You cannot get paid differently on a different transaction type. These aren't new laws, by the way. All these laws have been in effect since 2009. And yes, I'm aware that most of my competition is in violation of these laws. So if your company right now is paying you differently when you have to give concessions, not legal, that's stealing. If they're paying you differently, if you do a DPA loan, or if you're a banker right now and you broker a loan, they pay you differently, illegal, they're stealing from you. We don't do any of those things. Your compensation is static. Static. Few exceptions if you're doing open-ended lines of credit, because loan officer compensation laws don't apply to open-ended lines of credit or commercial. But aside from that, your loan officer compensation can't change on a transactional basis. So I'll just tell you right now, if you're working for a company where your compensation is changing transactionally for a variety of different reasons, not legal, and maybe theft from your company, which is unfortunate because a lot of loan officers do things because the company allows them to do things. So they just do it. What most loan officers don't realize is when they pass licensing laws, the licensing laws state that now that you're licensed, that you're as equally culpable as your company if you violate any of these laws. So if your company gets in trouble for compensation violations or fair lending violations, and you happen to be doing that, you're equally as responsible as your company. Nobody thought too much about that kind of stuff until NAR got whacked. And then they basically said, real estate agents that have been participating in this, which they all have been, are as equally liable as their companies. So again, not a lot of regulation. I mean, there's a ton of regulation on our industry right now. Much of it is not enforced now. But if you happen to get hung up in one of those snags, you could be in real trouble. Just because your company allows you to do it, you can't plead ignorance and do it and get off the hook. You're equally as liable. The bigger point being is that we'd never do those things, and I'm never going to steal from you. And
we had a question come in on product, if you don't mind. Attendee asked, at my current company, I'm constantly losing deals because we do not offer very many products that are outside of the primary box. What kind of offering do you have?
That's random. That's a rare thing outside of the box, because the overwhelming majority of loans that are done in the United States right now are agency and government. So if you're not covering those range, and that would be kind of a unique situation. So the only real, and I say this, the only real overlay that we have as a company is 580 credit score. They might be some really random overlays that we have out there, but I can't think of a single one other than the credit score. All the conventional, all the agencies, Fannie and Freddie loans we do, USDA, VA, FHA. So their whole product lines, all the agency and government products that are out there. We have all those. Again, the only overlay I can think of off the top of my head is the 580 credit score. We also have all the non-QM products, or all the relevant non-QM products. Non-QM is not a broker transaction. We've been banking that for probably 8, maybe 9 years now. No difference in compensation on non-QM loans, i.e. that would not be legal. So you make full boat on non-QM loans. It is a bank transaction. We have a first position home equity line of credit. That's a bank's transaction, although it's not covered by loan officer comp, so you can make as much money on that product as the investor allows, which I think is about 400 net. We have a small commercial division. We do open-ended reverse mortgages. We do second position HELOCs. Not exciting. There's not a lot of compensation in that, but you do get compensated on second position mortgages. Internally, we have a portfolio division where we have our own fix and flip and bridge loans. When brokers say that we have more loans than anybody, I mean, I got loans that they don't. So there's that. I can't imagine there's loans out there that we don't have that you would need. We have some farm loan products. We have the down payment assistance programs, both national and at state and regional levels. Again, not a fan, but we have them. And we tend to be very innovative. So as new products roll to market, like we were the first banker that had non-QM. We were the first banker that had the first position home equity line of credit. So we tend to roll out these products before most of our competition anyway. I hope that answered the question.
Yep, they did clarify they were more concerned about the non-QM stuff. And then someone asked, do we have doctor loans? I can confirm, yes, we do.
Yeah, and again, I wouldn't say it's super competitive doctor loan. Banks, there are some banks that are going to be much more competitive on that product. And in 17 years, we've done a handful of doctor loans. So there are one-off. We haven't. That's the easy answer. But you're probably not coming here just because of our doctor loan program. That makes any sense. Other questions?
Don't have any yet. You can continue on.
It's like drinking from a fire hose. I'm not even entirely sure. I covered a wide variety of topics. Maybe to sum it up in a nutshell, and you're certainly welcome to ask questions while I'm doing this, is we're different. Everybody will say that, but we are different. Maybe you'll get some feel that we're different just from talking to me over the last 45, 50 minutes. I didn't start this company to do what we did. I started it to accommodate me as a high producing originator. That's the only reason I did it. For me and a handful of people that I managed at the time, my former employer sold this company. I didn't aspire to have a company in 49 states with 700 employees. That happened by accident. We haven't changed our culture. We haven't changed our model. We've evolved as a company. We didn't have James and his brilliant marketing department 17 years ago. He's a new addition in the last, 5 years? So we've gotten better as a company, but I think that what made us the strongest and why we've done so well in up and down markets. I mean, put it this way. I started undercapitalized in 2007 when most of my competition was in rumbles, imploding. Thousands of mortgage companies going out of business, yet us undercapitalized were outperforming some of the biggest mortgage companies in existence, which we've done over the last 3 years. We have probably been one of the most profitable mortgage banks in existence in the last 3 years. And it's because my branch managers and originators didn't stop earning. They didn't have to, regardless of market. They didn't have to lower their value. They didn't lower their comp. We've never, as a company, lowered comp. Not once, not ever, nor will we ever. That's not my decision. That's the originator's decision. If you're not worth it, don't try to charge it. If you're worth it, charge as much as you want. Doesn't make any difference to me. We encourage our branch managers and our loan officers to earn, even though it doesn't change my income at all. Doesn't make any difference what our branch managers' margins are. Doesn't affect me at all. They could be at 200 net or 400 net. Doesn't change us. Doesn't change anything. But we encourage it. We encourage it. If you have a branch and you have aspirations to grow, we'll help you recruit. Not going to contain you to a particular area. In fact, I may tell you not to recruit in the area that you're in because there's better markets. We're in 49. There might be better markets with better profitability, better opportunity to grow that's not in your particular market. That's fine. Let's do that. And we'll help you do that. We'll help you recruit. And we've done that with a tremendous amount of success. And it's a scalable model. The people that you bring on as a branch manager, you can pay your loan officers lots. We have loan officers that are netting over 200. Netting over 200. I have to always stress the nets. It's not the same as gross. Brokers cannot pay as much as we do by law. So when brokers come out and say nobody can pay more than we can, liars, not true. Federal regulation mandates that the maximum a broker shop, a broker company can gross is 275. We have hundreds of branch managers that are netting over 300. So that's another lie, myth from the broker side. We pay more. We pay more and always have paid more, which is also a scalability issue. So we can scale. Brokers can't. They can't. It's next to impossible for a broker to scale. You don't see a lot of branch managers scaling in the broker platform. It's very, very hard. Not enough compensation to go around unless they do it on the backs of their loan officers, which we don't encourage. Our branch managers can hire loan officers at 150, 175, 200 basis points net with a processor, potentially with an LOA, with robust marketing, most of which we do on a daily basis for you. It's not canned. It's not third party. We don't talk about 2-1 buy downs because nobody cares, which is another reason if you're working for a company and you're pitching, today is the best time to refinance. Today is the best time to sell. 2-1 buy down this, 3-1 buy down that, and you're struggling. That's why. That's one reason. Nobody cares. So when it comes to marketing, you gotta do intuitive things. You gotta get eyes on you. And I promise you, nobody cares about a 2-1 buy down. Maybe the one person in your social networking network cares about a 2-1 buy down. The rest of them don't care. They don't care. So you got to be putting out content that people care about, that people are going to look at and they're going to like, and they're going to pause on and share and comments. That's what we do. And we do most of it for you. I shouldn't say I do. I'm not going to take credit for that. James and his amazing team, they do all that for you. I mean, literally for you, and you don't even pay for it.
Well,
Nothing.
and it's about understanding your audience too, and that's one of the benefits our loan officers and branches receive is what you just said. 2-1 buy down. The audience for that is not on social media. It's your agents. They're the ones that are going to care about it. So we're going to communicate that to your agents for you. And Aaron, we've got about 6 minutes left, and if you would humor me, I'd love for you to kind of wrap this up, talking about one of my favorite topics. And as someone that's been in advertising and marketing for 33 years now, my biggest criticism of companies inside of this industry and out is that their culture is not reflective of the company internally. It's a marketing activity. We all know that. I mean, that's what it is in a nutshell. However, I've made it my kind of career mindset that when I market a culture, it's got to be authentic. It's got to feel real, or it's going to backfire. in your face. And the good human thing kind of came about because that's honestly what already existed before I walked through the doors. We just put a name to it and a logo to it and a feel to it, but it all existed. So talk to everybody about the overall culture at Geneva and how that's kind of evolved.
Well, it's going to be really hard to do that in 6 minutes, but I'll talk fast and kind of give it to you in a nutshell. And I think that a lot of it stems with, I was born and raised in Seattle, Washington. My dad was a Seattle firefighter for 33 years, and I wanted to walk in his steps as a firefighter and be a civil servant. I wasn't a capitalistic business-minded person. I was a civil servant-minded. I wanted to help people. That's all I wanted to do, was help people. And voila, I wound up running a mortgage bank. Sometimes it doesn't, things don't work out the way you think they are. But my upbringing and my belief system has never changed. And when I met James years and years ago, he said, what are you looking for, as he was trying to, help us rebrand and kind of find our way from a marketing perspective. And I said, I'm looking for good people. But what I didn't mean is production. I meant good in character, good-hearted people. And that moves the needle for me more than anything else. Life's too short to deal with a bunch of not so nice people, not good people. And we're not always successful, and sometimes we bring on people with good production that may be a little bit of a jaded character, and we try to work with them and try to get them to see the world a little bit differently. Sometimes it works, and most times it works, but not all the time. But it's more important to us to work with other people that actually care. And that means branch managers that care about, evolving and mentoring and paying and helping their loan officers earn and grow their business. Loan officers that care about their consumer, care about them. And that doesn't mean just saying yes to every loan you get a AUS approval on. I always say, just because it says yes, approved, doesn't mean it's a good thing to do to your consumer. So are they good people? Are they actually looking out for the best interests of their consumer? That's hugely important, and I think mostly not done in our industry. And then amongst one another, we have an abundance mentality. And we're not worried about people stealing from one another. I think one of the coolest things that we've been able to keep as a culture within this company is my highest producing originators and branch managers will hold Zoom calls with the entire company and teach them how to do the things that they're doing with success, because they're not worried about losing deals to you. They want you to become more successful. They want you to challenge them for the top 10 position every single month. They want success because they know if they can help breed that success within the company, it brings us all up. And it does. So I think that, you gotta be a good human. That's our motto. We live by it. And again, it's not always easy to do that. We are human, by the way. It's easy to have a bad day and go off the rails. I've been there. It's a stressful industry. It's a stressful job as an originator, especially when you're commissioned and the sales and all these things that can happen that you don't have control over. It's stressful. You may not be your best self every single day, but try to be. And when you go off the rails, try to realize that you went off the rails and be respectful and apologize and help people out. And it's just such a healthier work environment for everybody. So that's about all I got to say. It's hugely important to us. Again, if you're high producing and a total asshole, I don't want you. Don't call me. Not interested. Don't care.
That's our new slogan.
Okay. And I'll leave it at this. Listen, it's very easy to get a hold of me directly. If you look me up on LinkedIn, my cell phone number is there. You can call me directly. I'll have a conversation with anybody. I love doing this. I love helping people become more successful and seeing the world a little bit differently. So I encourage it if you want to reach out at any time. I'm transparent, very unfiltered a lot of the times, but I'm not going to lie to you, and I'm going to do everything I can to help you.
Outstanding. If you guys want more information on Geneva Financial and what we offer, joingfi.com is your web address to visit. There's plenty there to purview. And if you would like to schedule a conversation with Aaron, email me at james@genevafi.com and we'll get you taken care of. Aaron, appreciate your time. I know it's valuable and I love that you were here.
Thanks, James.
Thanks, sir.
Till next time.
You too.